Now, the reality is that this beautiful, magical business is never going to work in that way. Just think about the fact that if you want to sell some ice creams, you're not just suddenly going to generate revenue from 10 units by, out of thin air. The reality is that you're always going to have to do some kind of capital expenditure to be able to, well, just even produce the first batch of inventory that you're going to need to bring to the market. So that capital expenditure has to be financed in some way. You cannot just make that happen without any financing. So if you just want to build up your ice cream inventory, the first thing you're gonna have to do is raise some dollars to be able to build up that inventory. And this is why the realistic, kind of like more realistic approach here, like what's really gonna happen in practice is that in some way you're gonna want to issue something, whether it's debt or stocks. You're gonna want to issue a claim to the business, to the operating revenue of this company, or to the final retained earning of that company through the issuance of stocks or shares essentially in that business. And so the way that it's usually going to happen is you're going to issue some stocks that are worth, a certain amount of money, let's say for instance, $1,000 at the very beginning of your operations, kind of like even before you start operating as a business. And that issuance of stock is precisely what you're going to need to raise some dollars to be able to create and build up your inventory. Now, because you have these $1,000 that are part of your company on the year 2021, well, essentially what you can do is you can already start spending some of that value, let's say somewhere around like 50% of it, to essentially build up your inventory. Now, that's going to be a mix. There's going to be the actual inventory itself. So there's going to be the raw material that's going to go into preparing the ice creams. You're very likely going to need to do some initial outlay of capital as well. Some kind of marketing is going to be needed to make sure that people know that your marketing stance is somewhere. You're going to have to pay somebody very likely to produce this ice cream or to do anything like on the shop. And and then because you're going to need to register your revenues and your profit, you're very likely going to have some general administration that's going to be happening. You're going to have to pay the lights of your shop or any other overhead expenses that are going to be part of your daily operations as well. And so if you see what's going to happen on your first year of operations, you're essentially going to be in a situation where you're generating a negative EBITDA. So you don't have a profit, you don't even have an earning before interest, depreciation, and amortizations. You don't even have, you're not paying any taxes because you're not generating any taxable revenue to be able to, to pay taxes. So really, at the end of the day, on your first year of operations, when you start building up your inventory, you're just going to have a negative, like a net profit. It's just essentially negative. And the only way why you can sustain that negative profit, like the only way why you can generate that negative profit, is because you have injected that initial issuance of capital in your company. You've issued these stocks that have allowed you to raise $1,000 of cash that you can spend on all of these operating activities that allow you to build up your inventory. Now, you have the initial issuance of stock and you have the negative retained earning. This is kind of like what you've been generating here on your first year of operations. Obviously, you haven't paid any dividends, so that's the final retained earning. Now, if we look at the cash flow statement, what's happening is that we have this initial outflow of capital, like we have this initial outflow of cash, we're actually losing cash from the operations that we have, because again, we're just essentially building up inventory, right? And we have this initial issuance of stocks, which is essentially pumping up our free cash flow, our financing cash flow. So kind of like the cash that's coming into the company from financing decisions that we've taken. So if we kind of like look at the difference between the two, if we kind of like look at the change in cash, which is the $1,000 that we've injected minus the $900 that we've left, we have this $100 at the end of the year. Now, because we have an operating business with an actual financing of our operations and some actual use of our inventory to be able to generate some revenue over the next period of times, what we can start to look at is kind of like the health of our company. And this is exactly where our ratios are starting to become important. So we can already take a sneak peek at the different indicators of how well our company is performing in several different dimensions. So obviously there is a ton of ways that you can do this, but personally what I like to do is I like to look at my different statements in isolation, and then I like to look at indicators that mix various concepts from all of these different statements. So the way that I break down my analysis of a company is between profitability, solvency, efficiency, liquidity, leverage, and performance and valuation. So these are the different dimensions that I like to look things at. And we're going to start with a very simple look at our profitability metrics. I mean, as you can see, there isn't much to see. The reality is that our growth margin is pretty stable across time. This is by construction, right? This is because essentially we've assumed that we've been generating a healthy, stable revenue with a proportional cost of revenue associated with it at 20%. So this is why our gross profit has been proportional across time and our gross margin has been stable. Now, what you want to have here is clearly like a very strong and hopefully growing gross margin that essentially tells you that you're becoming more profitable across time. This is the same for the EBIT margin and the net margin. In all of these instances, really, again, our assumptions are showing stable returns, but this is where we're going to start seeing divergence across time. The most important thing we're going to look at right now are the performance metric that we can already have a look at. The reason why we can look at this performance metric is because we've already injected some capital in that company, and we've already put that capital to use to increase the operational profit of that company and therefore to generate a return for stakeholders. Now, let's take, for instance, return on equity. That's one of the most important metrics to keep our eyes on. Remember, this is a pretty simple metric to look at. This is essentially the total amount of equity that we've raised, right? Like the money that we've injected from equity holders by issuing common stock, which has stayed stable at $1,000. Not even stable, but just static, let's say. We've put in $1,000, it hasn't changed, we haven't raised any new capital. So this is really what people have put into that business. And people who have a claim on that business are going to want to benchmark the return that they do on that initial outlay of capital that they've put in. In other words, the question is, how has our ability to generate operating profits and net profits, how has that return compared to the initial outlay of capital that we've had to do as equity holders in this company? Well, this is exactly what our return on equity ratio tells us. The reality is that over 2021, we had a pretty bad return on equity. I mean, if you think about it, we essentially put in $1,000 to essentially generate a negative return, a negative profit of $900. And we know that from the cash statements, we know that that $900 was an actual cash outflow. It's actual cash that is gone, that has been put into stuff that cannot be, given back to stakeholders. So we've essentially generated a negative equity return. But we've done it for a very specific purpose. We've done it for the ability to generate future positive cash flows. And this manifests itself already in 2022 when, just with our initial outlay of capital, we have been able to generate a starting revenue of $150, which essentially converted into $102. So again, 68% profit margin. So this is an amount of profit, and again, not just profit, an actual cash flow, an actual cash generation that is physically present on your final bank account. And that cash flow, that free cash flow that's available for stakeholders is exactly what we're going to benchmark against the $1,000 equity issuance. And this is what allows us to see that over the first year, we've been able to generate a 50% return. So that 50% is the net profit generated over the period 2022 over the total shareholders' equity. So again, the total available amount of equity that's available to stakeholders, to shareholders, which is again the value that they would get if we were to close down the operations of the company. So this is essentially the money that they have at stake by having this company running its operations. And so that tells us that essentially we are able to generate a 50% return on equity, or in other words, for every dollar of equity that we have, we're able to generate a 50 cents on that dollar. And that's usually pretty good. It's been declining, not because we're unable to generate a sustained net profit, but just simply because we are now comparing that profit to an ever increasing pool of capital available to the stakeholders. In other words, because the pie is growing, then every time we generate a new piece, we are essentially generating increasingly less of a return for our stakeholders. So we do need to start increasing our net profits. If we don't increase our net profits, if we keep generating net profit at the same pace, it means that our return on equity is going to start getting lower and lower, and investors are going to become more and more uneasy with leaving their equity in that company, when in fact they could be generating a higher equity return somewhere else. So we've had a look already at the interplay between income, balance sheet, and our first ratios when we start raising some funds, when we start financing our operations. We're going to move on to more advanced topics, so stick around.